So our last question comes from Lucas C. Lucas says, I'm 24, I have a solid investing background, and I've been a fan of the show for a while. Thank you so much for all you do. Recently, my parents, who are both in their mid-50s, have expressed concerns about their 401k performance. They've got $165,000 saved, and they're contributing $600 per month, aiming to retire in about 15 years. Right now, nearly all of their money is in a 2040 target date fund, which hasn't performed well at all. Since they have limited investment knowledge, I've offered to help them shift their portfolio into better options with more growth, ideally ETFs that track the S&P 500 or total market indices. While I'm personally comfortable taking on these types of risks, I want to find the right balance for them, maximizing returns without exposing them to unnecessary risk, especially given today's market conditions. Any advice that you all might have on building a better allocation for them would be greatly appreciated. Thanks in advance. Robert, you want to kick this one off?
I do. And I really appreciate it that, Lucas, you're looking out for your parents, because I see so many portfolios every week of people that are just in a target date fund. They don't know what it's invested in. They don't know if they have other options, and they just don't pay attention to what's in their 401k and what's happening. So I'm really glad early enough you caught this to be able to say, all right, we're going to draw a line in the sand and we're going to do something about it. Because at the end of the day, my problem with target date funds are they underperform simply the S&P 500 and the NASDAQ, but also the fees are high and it doesn't take into consideration anything that's happening in the market, because the goal of a target date fund is to preserve your cash, not grow it. And that is why they generally underperform the open markets. So I love where your head's at, and you're absolutely right. You need to see, are there other options to get their money working as hard for them as they work to get it? And of course there will be. Maybe you find a situation where they stop putting this extra money in the 401k. They put in just the minimum to get the free money, and everything else goes into the funds we talk about. They could have a bridge account that would help them. And in that bridge account, take this additional money, the $600 a month that's over and above, and put that into the VOOs, the QQQs, maybe the VUGs of the world, VTI. Some of these funds are really, really good funds and perform well. And then maybe they could have a small portion into some bond accounts. A BNDI might be great for them, a NEOS fund that we like. But then also you could put a small portion maybe into Bitcoin and get some of the nice growth that's there. Because at the end of the day, they have another 10, 15 years in their investing horizon before retirement. And we want to make sure we can capitalize on as much growth as possible. Because I think the number one biggest mistake people have made for the past 30 or 40 years is thinking that a 401k is a retirement strategy. It is not. It is better than nothing because you're getting the free money from the match, but generally there are limited options and they underperform. So it really makes me happy, Lucas, that you're keeping an eye on it, helping them out, and getting them the guidance they need to get better returns with better products.
I couldn't have said it better myself. My perspective is continue this $600 a month. And then to also remember though, like you mentioned 15 years, right? 15 years is a long time for whatever tariff tantrum or 2022 bear market or whatever volatility we're seeing in the markets, right? Volatility normally lasts 13 to 15 months. That's the average length of a bear market before we're back to trending in the right direction again. And so just know that that's a year to a year and a half. So by having a mentality of I'm going to go risk off 15 years before I retire so I can maybe try and preserve my capital, that to me is just a little too much, right? So here's the statistic. There's an 85% chance that you can buy the S&P 500 on any given day, wait 5 years while reinvesting those dividends like we always tell you to do, that you will be in the green at the end of that 5-year period of time. You can literally just throw a dart at a dartboard, pick any day in history, and that will be an 87% chance. And so why I share that statistic is, if you're someone right now who's worried about where the S&P is going to be at in 15 years, statistically speaking, we're going to be much higher in the markets in 15 years than we are today. So there's no reason, in my humble opinion, that someone should go completely risk off with these target date funds and this capital preservation at such a long period of time away from their retirement age. I think to Robert's point, right, we always talk about this portfolio strategy of 65 to 85% of the portfolio invested into these index funds and ETFs we talk about, and then the other 15 to 35% of the portfolio diversified across, if it's some single stocks, some NEOS funds, some gold, some bonds, whatever you want to do from that perspective. So that's really where our heads are at. Let's really call it a 30-70 split between some diversification and these index funds and ETFs that we talk about. I think that's an awesome strategy. I think that's a great weighting. And by taking this episode's answer and showing it to your parents, hopefully Robert and myself will be able to explain to them why a 2040 target date fund might be a little too risk off for their appetite at the moment.
And for everyone else listening that doesn't have an awesome son like Lucas, make sure you understand in your 401k or any brokerage accounts where you're getting help. Make sure you understand the fee structure. What are you actually invested in, and what are the returns year over year? Because so many people just turn a blind eye to their funds and say, hey, I'm putting all this money in, I'm going to be great, because they see a little bit of growth from time to time, but they don't truly understand it. And that's why it's so important to dig in, have the hard conversations, understand what you're doing with your money, because you want to make sure you're optimizing growth over time for the long term. I hope this helps some of you, because it's so important to understand what your money's doing, where it's going, and is it the best solution for you?